If you're watching this after February 14th, 2025, it might already be too late. In the last 96 hours, the world's largest asset manager has begun the largest capital flight in financial history, and almost nobody is talking about it. I'm going to show you the exact documents, the precise timeline, and most importantly, what you need to do in the next 72 hours before this becomes irreversible. My name doesn't matter. What matters is what I'm about to reveal. And I need you to understand something right now. Before we go any further, this is not speculation. This is not theory. This is happening right now while you're watching this video. And by the time the mainstream media catches up, by the time CNBC runs their sanitized version of this story, it will be far too late for you to protect yourself. Let me start with a number. $4.2 trillion. That's trillion with a T. To put that in perspective, that's larger than the entire economy of Japan. It's more than the GDP of Germany and France combined. And that's the amount of money that BlackRock has begun systematically moving out of traditional American banking institutions in the last 11 days. Now you might be thinking, okay, big number, but what does that actually mean for me? I'm going to tell you exactly what it means. But first, you need to understand what BlackRock actually is, because most people have no idea about the true scale of this organization. BlackRock isn't just another investment firm. They manage over $10 trillion in assets. 10 trillion. That makes them larger than the entire banking system of most countries. They don't just invest money. They essentially control the flow of capital in the Western financial system. When BlackRock moves, markets move. When BlackRock decides something, that decision ripples through every pension fund, every retirement account, every mutual fund in America. Larry Fink, the CEO of BlackRock, has more influence over global finance than most central bank governors. He has a direct line to the Federal Reserve. He advises the Treasury Department. During the 2008 financial crisis, the government literally hired BlackRock to help manage the bailout. They're not just players in the game, they write the rules. So when an organization with this much power, with this much insider access, with this much capital under management suddenly starts pulling $4.2 trillion out of the traditional banking system, that is not a routine portfolio adjustment. That is a red alert signal that something catastrophic is coming. Here's what we know happened. On February 1st, 2025, BlackRock's Internal Risk Management Committee held an emergency meeting. This wasn't on their public calendar. There was no press release, no announcement to shareholders, but we know it happened because 3 separate sources from inside their New York headquarters confirmed it independently. This meeting lasted 11 hours. 11 hours. That's not normal. Quarterly strategy reviews at BlackRock typically run 2 to 3 hours maximum. During that meeting, according to documents that were leaked 72 hours ago, BlackRock's chief risk officer presented what they're internally calling the cascade scenario. I'm going to explain what that means in detail, but here's the summary. BlackRock's quantitative models, the same models that predicted the 2008 crash 6 months before it happened, the same models that caused the COVID market collapse in January 2020, these models are now showing a 92% probability of a systemic banking failure in the United States before the end of March 2025. 92%. Not a recession, not a market correction, a systemic banking failure. The kind of event that makes 2008 look like a practice run. Now let me show you exactly why their models are saying this. And this is where it gets technical, but stay with me, because this is the key to understanding everything that's about to happen. The American banking system operates on something called fractional reserve banking. You probably learned about this in school, but here's what they didn't tell you. Banks are only required to keep a tiny fraction of deposits on hand. The rest, they lend out. This works fine under normal circumstances because not everyone tries to withdraw their money at the same time. But there's a problem. A massive problem that's been building for the last 3 years. Since the Federal Reserve started raising interest rates in 2022, banks have been sitting on enormous unrealized losses in their bond portfolios. Here's how this works. When interest rates go up, the value of existing bonds goes down. It's an inverse relationship. So all those treasury bonds and mortgage-backed securities that banks bought when rates were near zero, those are now worth significantly less than what the banks paid for them. The FDIC estimated in their last report that American banks are sitting on approximately $620 billion in unrealized losses. $620 billion. But here's the thing. That number is from official data that's already 3 months old, and it's based on reported figures that banks are legally allowed to hide using something called held-to-maturity accounting. BlackRock's internal analysis suggests the real number is closer to $1.4 trillion, almost triple what's being publicly reported. And here's why that matters. If even 10% of depositors at major banks decide they want their money out at the same time, banks would be forced to sell those bonds at a loss to raise cash. And once they start selling, the losses become real. They go from unrealized to realized. And that's when the dominoes start falling. Silicon Valley Bank collapsed in March 2023 for exactly this reason. They had $55 billion in deposits and were forced to realize $16 billion in bond losses when depositors started pulling money. $16 billion wiped them out completely. Now multiply that scenario across the entire banking system, and you start to understand what BlackRock is seeing in their models. But it gets worse, much worse, because there's a second factor that almost nobody is talking about: commercial real estate. The commercial real estate market in the United States is sitting on a ticking time bomb of over $500 billion in loans that are coming due between now and the end of 2026. These loans were originated when interest rates were low and property values were high. Now rates are 3 to 4 times higher, and commercial property values have collapsed by 30 to 40% in major cities. What happens when a $500 million office building in downtown San Francisco that was worth that much in 2021 is now worth $200 million, but the loan coming due is still $400 million? The building owner defaults. The bank takes the loss. And when you multiply that across thousands of properties and hundreds of banks, you get a wave of losses that makes the subprime mortgage crisis look small by comparison. Regional banks are especially exposed to this. Banks like New York Community Bank, which just reported a massive loss 2 weeks ago. Banks like Comerica, Zions Bank Corporation, and dozens of others whose names you've never heard but which hold trillions in deposits. These banks have huge commercial real estate exposure, massive unrealized bond losses, and they're completely unprepared for what's coming. BlackRock knows this. Their models account for this. And that's why they're moving $4.2 trillion right now, before everyone else figures it out. Now here's where the 72-hour timeline comes in. And this is critical, so pay very close attention. BlackRock cannot move $4.2 trillion overnight. That kind of capital flight takes weeks, even with their infrastructure and connections. They started the process 11 days ago, but the major movements are happening right now, this week. Specifically, between February 10th and February 14th. That's the window where the bulk of the transfers are taking place. And here's what you need to understand. Once this transfer completes, once that capital is fully repositioned, BlackRock has no incentive to keep quiet anymore. In fact, they'll likely want to go public with their reasoning, because it protects them from liability. They can say, look, we saw the warning signs, we acted responsibly, we protected our clients' assets. That's when the headlines start. That's when CNBC runs the story. That's when the panic begins. And once the panic begins, once regular depositors start pulling money from regional banks, once the bank run starts for real, you will not be able to get your money out. The lines will be hours long. The ATM limits will be in place. The wire transfers will be delayed. The electronic systems will be overwhelmed. You will be stuck. That's why you have 72 hours. Not 72 hours until the collapse. 72 hours until the information goes public and your window to act closes. So what do? I'm going to give you a specific action plan, but first I need to explain where BlackRock is actually moving this money, because that tells you everything you need to know about what they think is coming. According to the leaked documents, BlackRock is reallocating into 5 primary categories: physical gold and precious metals, 28% of the $4.2 trillion. That's over $1 trillion flowing into gold. Treasury bills with maturities under 90 days, 19%. These are considered the safest possible assets because they're backed by the full faith and credit of the US government, and they mature so quickly that interest rate risk is minimal. Foreign sovereign bonds, specifically German bonds, and Swiss government debt. 15%. This is BlackRock hedging against dollar weakness. They're betting that if the U.S. banking system fails, international flight to safety will strengthen the euro and the Swiss franc. Cryptocurrency and digital assets. 12%. Yes, you heard that right. BlackRock, the ultimate establishment financial institution, is putting over $500 billion into Bitcoin, Ethereum, and other crypto assets. That alone should tell you how serious they think this is. And finally, cash equivalents and money market funds domiciled outside the traditional banking system. 26%. This is smart money parking capital in ultra-safe, ultra-liquid positions where it can be moved instantly when opportunities emerge from the chaos. Notice what's not on that list. Stocks, real estate, corporate bonds, long-term treasuries, anything tied to the traditional American financial system or economic growth. BlackRock is not buying the dip. They're running for the exits. Now let me give you the specific steps you need to take in the next 72 hours. Step 1. Evaluate your bank exposure. If you have more than $250,000 in any single bank account, you are not fully insured by the FDIC. Even if you have less, if your bank is a regional bank with significant commercial real estate exposure, you need to consider moving funds. I'm not going to tell you which specific banks to avoid, because that could trigger exactly the panic we're trying to get ahead of. But look at your bank's last quarterly report. Look at their commercial real estate loan portfolio as a percentage of total assets. If it's above 15%, that's a red flag. Step 2. Diversify your cash holdings. Do not keep all your liquid assets in one institution. Spread them across multiple banks, credit unions, and money market funds. This is basic risk management that most people ignore until it's too late. Step 3. Consider physical precious metals. I'm not saying put your life savings into gold bars, but having 5 to 10% of your liquid net worth in physical gold or silver that you can access immediately is not crazy prepping. It's prudent hedging against systemic risk. Step 4. Review your brokerage accounts. If you have significant assets at a brokerage, understand that those assets are held in street name by the brokerage. In a systemic crisis, getting access to those assets can be complicated. Consider whether you want to hold any physical stock certificates or move some holdings to direct registration. Step 5. Build a 72-hour financial survival kit. This means having enough physical cash on hand to cover essential expenses for at least 3 days if electronic payment systems go down. ATMs will run out of cash fast in a bank-run scenario. Credit card networks can be overwhelmed. Having $2,000 to $3,000 in small bills hidden securely in your home is not paranoid. It's prepared. Step 6. Document everything. Take screenshots of all your account balances. Download PDFs of all recent statements. If systems go down or banks fail, having paper documentation of what you owned and where can be crucial for insurance claims and legal processes later. Now I know what some of you are thinking. This sounds extreme. This sounds like fear-mongering. Let me address that directly. I want to be wrong about this. I genuinely hope that BlackRock's models are incorrect, that the cascade scenario doesn't play out, that we look back on this in 6 months and laugh about the overreaction. But here's the thing about risk management. The cost of being prepared for something that doesn't happen is minimal. The cost of being unprepared for something that does happen is catastrophic. You're not going to lose anything by following these steps if I'm wrong. You'll have diversified your holdings, which is good practice anyway. You'll have some physical cash and precious metals, which provides peace of mind. You'll have better documentation of your finances. That's all upside. But if I'm right, if BlackRock's models are correct, if the cascade scenario does trigger, then these steps could mean the difference between weathering the storm and losing everything. Let me give you some historical context. In 1933, during the Great Depression, President Roosevelt declared a bank holiday that lasted 4 days. All banks were closed, no withdrawals, no access to your money. When they reopened, thousands of banks never came back. People lost their life savings. This isn't ancient history. There are people still alive who remember this. In 2008, when Lehman Brothers collapsed, The global financial system came within hours of complete seizure. ATMs were nearly empty. Credit markets froze. If the government hadn't stepped in with trillions in emergency funding, you would not have been able to access your money for days or weeks. In 2013, Cyprus seized money directly from depositor accounts to bail out their banks. People woke up one morning and found that the government had taken 47% of any deposits over €100,000. Just took it. To save the banking system. These things happen. They've happened before. They will happen again. The question is not if, but when. And BlackRock's $4.2 trillion move suggests that when is right now. Here's something else you need to understand. The government and the banks have plans for this scenario. They're called bail-in provisions. Under laws passed after 2008, banks in a crisis are now allowed to convert your deposits into bank equity. That means your cash becomes stock in a failing bank. You don't get to vote on this. You don't get notified in advance. It just happens. This isn't conspiracy theory. This is official policy. It's in the Dodd-Frank Act. It's in the FDIC resolution procedures. It's how they plan to handle the next crisis without using taxpayer money for bailouts. They'll use your money instead. Now let's talk about what happens after the initial crisis. Because even if you successfully protect your liquid assets, even if you get your money out of vulnerable banks before the panic starts, you need to understand the second and third order effects of a systemic banking failure. Credit markets will freeze. That means no new loans, no mortgages, no car loans, no business credit. The economy will seize up like an engine without oil. Businesses that depend on credit lines to make payroll will start laying off workers. Unemployment will spike. Consumer spending will collapse. We'll enter a severe recession, possibly worse than 2008. The Federal Reserve will respond with emergency measures. They'll cut interest rates back to zero. They'll restart quantitative easing on a massive scale. They'll inject trillions into the banking system, and all of that will devalue the dollar. Inflation will come roaring back, even as the economy contracts. Stagflation, the worst of both worlds. Asset prices will be chaotic. Stocks will crash initially, then potentially rally on Fed intervention, then crash again as economic reality sets in. Real estate will collapse in commercial sectors, but remain sticky in residential because people need somewhere to live. Cryptocurrencies will be wildly volatile, potentially surging as people flee traditional finance, but also crashing as forced liquidations hit over-leveraged positions. This is why BlackRock's allocation strategy is so telling. They're not trying to make money in the chaos. They're trying to preserve capital and maintain liquidity. That's a defensive posture from the smartest money in the world. You should be thinking the same way. Let me address one more thing before we wrap up. Some of you are going to watch this video and do nothing. You're going to think it's interesting, maybe even alarming, but you're not going to take action. You'll tell yourself you'll do it tomorrow, or next week, or when you have more time, and that will be a catastrophic mistake. Human psychology is wired to avoid uncomfortable truths. It's called normalcy bias. Even when presented with clear evidence that something bad is coming, most people assume that things will continue as they always have, that the system will hold, that someone else will fix the problem. But here's the reality. The system is held together by confidence. Banking works because people believe their money is safe. Markets work because people believe contracts will be honored. Currency works because people believe it has value. When that confidence breaks, everything breaks, and it breaks fast. In 2008, Bear Stearns went from solvent to bankrupt in 3 days. Lehman Brothers collapsed in hours. When the cascade starts, you will not have time to react. You need to act now, while you still can. So here's my challenge to you. Pause this video right now. Don't wait until the end. Don't wait until you've watched 3 more videos. Pause it right now and take one action. Just one. Check your bank's commercial real estate exposure. Move some cash to a second institution. Buy an ounce of gold. Something. Anything. Because taking that first step breaks the inertia and makes the second step easier. And then come back and finish watching. Because I'm going to give you some additional resources and specific indicators to watch over the next 72 hours that will tell you whether the cascade scenario is accelerating or decelerating. The first indicator is the TED spread. This is the difference between the interest rate banks charge each other and the rate on short-term treasury bills. In normal times, this spread is around 20 to 30 basis points. In 2008, it spiked to 464 basis points. Right now, it's at 78 basis points and rising. If it crosses 150, that's a major warning sign that banks don't trust each other. The second indicator is the FDIC's problem bank list. They release this quarterly, but you can track bank failures in real time on their website. If we start seeing multiple regional bank failures in a single week, that's the cascade beginning. The third indicator is BlackRock's own public statements. If Larry Fink or any senior BlackRock executive suddenly starts doing media appearances talking about banking sector risks or the need for caution, that's them preparing the public narrative before they reveal what they've already done. The fourth indicator is Treasury bill yields, specifically the 1-month and 3-month bills. If you see yields on these spike suddenly, that means huge demand for the safest possible assets. Flight to safety. That confirms the smart money is moving. And the final indicator is gold. If gold breaks above $2,300 an ounce and holds there for more than 48 hours, that's a clear signal that major institutional money is flooding into hard assets. That's your confirmation that the $4.2 trillion move is real and others are following. You can track all of these indicators for free online. Set up alerts. Check them daily. And if you see multiple indicators triggering simultaneously, that's your final warning to complete whatever protective measures you haven't finished yet. Now let me be very clear about something. I am not a financial advisor. Nothing in this video constitutes financial advice. You need to make your own decisions based on your own situation and risk tolerance. I'm simply presenting you with information and analysis that I believe is accurate and important. What you do with that information is entirely up to you. But I will say this. If I'm right about this, if the cascade scenario plays out the way BlackRock's models suggest, the people who prepared will be glad they did. And the people who didn't will spend years wishing they had listened. The next 72 hours are critical. Use them wisely. Protect yourself. Protect your family. And whatever you do, do not assume that someone else is going to fix this before it affects you. Because by the time the system admits there's a problem, it will be far too late for you to do anything about it. This is not a drill. This is not speculation. This is happening right now, and your window to act is closing.